Everyone. Firstly, while we wait slightly for more people to join in, let me share with you our unit trust platform fee waiver promotion. From now till 30th June 2026, enjoy zero platform fee on all your unit trust holdings. To find out more, please scan the QR code or reach out to your trading representative. Details of this promotion can also be found on our website utrade.com.sg. So additionally, we are also now on Telegram. Do remember to join our channel UOBKH Trading Ideas for the latest market insights and promotion simply by scanning this QR code. This evening, we will be hearing from Paul Deverneau and Adam Petty from Vista Shares. They will be discussing on Warren Buffett's strategies and legacies. There will be a short Q&A session after the presentation. Feel free to send us your questions via the chat box. We will also appreciate if you could take a few minutes of your time to complete the survey form that will pop up after this session ends. Now, without further ado, I will hand the time over to Paul.
So everybody should see the screen perfectly. If you don't, if I'm doing something using the technology wrong, please send me a message in the chats. Okay, they've recently upgraded our software here, and I'm not 100% certain I'm using it correctly. So I do need your help if I'm doing something wrong. Okay, there's a picture of me. There's a picture of Adam. There's my bio. Once again, I say this every time. I subscribe to the UOB Telegram channel. It gives me all the updates on everything that's going on. It's really helpful. I suggest you do it, but there's so much stuff on it. Please turn off the notifications. Otherwise, your phone will be going crazy all day. But, once a day or two, just scroll through and see if there's anything there that interests you. Okay. Please also tune in to my weekly updates. They're on our Facebook page, they're on YouTube, they're on two different KHN YouTube channels. Lately, my viewerships are up. I'm very excited about that. And yesterday, I did one and I predicted that after the Fed did its quarter basis point rate cut, I actually said that I thought the market would go down a little bit. And that turned out to be exactly right because I didn't say it was going to go down a lot. I said it was going to go down a little bit, and that's what it did. Okay, here's a little introduction. As you can see, Adam comes well recommended because when I mentioned that he was going to be our guest last month, Dan Ives immediately piped up that he had done a podcast with Adam. And he said, if you're interested in Warren Buffett, you'll find this very interesting. So that's quite a recommendation. And we'll get going into the presentation. I'm going to do one slide only on the Fed before we get going, since that's the topic of the day. And what you should think about is what's interesting going on is that the Fed began cutting interest rates with the S&P 500 at an all-time high, and with the Atlanta Fed GDP now, which isn't necessarily super accurate the way it's meant to be a running total of how good the data is going, but third quarter data is going very, very well. Atlanta Fed GDP now is showing 3.3% growth. That's very strong US growth. So the Fed is cutting while data is good, even though there's signs of a weakening labor market. The overall data is good. And FactSet has earnings growth for the third quarter at 7.6%. And if you think about how typically when companies actually give their actuals, they tend to beat by 3 or 4%, it's almost a lock that we're going to have double-digit earnings growth for the third quarter. So the Fed began cutting with US corporations having double-digit earnings growth. US economic data, not being perfect, but overall you have to say strong, not weak at all. And also with the Fed not just doing a one-off cut, but indicating another rate cut in October and December as well. And I'll give Adam a chance. Do you want to add anything to that analysis?
No, I mean, it's well done. I mean, it's interesting. There's a lot of conflicting data, as you said, and but I think they're erring on the side of I would say being conservative, but maybe it's being aggressive depending on how you're looking at it. But I think overall the quarter point cut was good. I think the guidance was good. A couple more cuts this year, and wait and see next year, see how it goes.
Okay, so now I'll just do a quick review that our guest last month was Dan Ives. I'm very pleased with all the nice comments people sent to me about Dan speaking. That was really nice. Dan is, generally he's bullish, but look at this chart here of what the market has done since Dan spoke to us, last month. You have the market up. Now I have to what is the market up here? I get the market return since the August 21 seminar for the Dan Ives ETF, the IVS. It's up 15%. So you can say that Dan is always bullish, but you could say that Dan is very often correct. And just also because Dan's compliance people didn't want Dan or me to speak too much directly about the ETF during the webinar for various reasons that I thought were wrong. But Dan did, of course, bring up that he wanted you to follow him on X. And so I just put up here, this is the kind of thing you'll see on X. This was pretty much right around when we did the webinar, and Dan did mention this, that he did a reshuffle of some of his stocks, and you can see how he added CrowdStrike, Roblox, GE Vernova. And I just wanted to add to that, this goes along with what Dan said. He's not worried about buying stocks at high PEs. He's not worried about buying stocks that have already gone up a lot. If he sees the growth in the future, he recommends it. GE Vernova, he's recommending. I was looking at it. Maybe it's gone up since Dan's put it in his ETF, but that is up about 180% this year, I think, which is quite good. Okay, and this is just a picture of what you would see if you logged into Dan's X account, which makes it easier to see which stocks that he owns in the ETF. I'm going to toot my own horn a little bit because the one stock that I asked Dan most about during the presentation was Oracle. And of course, so that was great that I had him focus in on Oracle, because Oracle, after he spoke, just went crazy up. So that was a good one to focus on. Okay, now we're into the main target. We're talking about Berkshire Hathaway. We're talking about Warren Buffett. So basically, what we want to show you here is sort of the one-year track record of Berkshire Hathaway versus the S&P. And one of the interesting things that was going on is that Berkshire Hathaway was outperforming the S&P going into April. And then April, when the Trump made his, what do you want to call it, his a Liberation Day speech, both the S&P and Berkshire dropped. But since then, Berkshire has been trending downward, and the S&P, of course, has gone to record highs. So he's outperforming this year. But if you look over the last 5 years here on the right, I mean, you can see that Berkshire has actually outperformed the S&P 500 over the last 5 years. So that's, tells you, like anyone thinking whether Warren Buffett has lost his stuff, I mean, basically investing with Buffett continues to work. Now, this is sort of like the first question for Adam, because he's the Berkshire guy. When you look at Berkshire shares by itself, a lot of people point out that Berkshire has this huge cash hoard. And one of the questions I had is, given the way the stock market has gone up so much, given the way that the value of Berkshire relative to the, to how much it costs to acquire a company these days, big, the kind of company that Berkshire would want to buy these days, and relative to Berkshire's, cash flows and everything else, is this really a gigantic cash hoard for Berkshire? Should people look at that and say, oh, this is a sign that Warren Buffett is very bearish the market and feels a need to hold a lot of cash? What do you think, Adam?
I don't think so. I think it's, and I don't have all the numbers in front of me, but in terms of percent of their total asset base, it's kind of in line historically, perhaps a little elevated. The reason for it is, they are generating, billions of dollars of dividends internally that they're, socking away in their cash hoard every quarter, every month. So it's growing a lot faster just based on the nature of their overall portfolio, which is interesting. I don't see that Buffett, and he certainly hasn't come out and said much, that the market overall is expensive. But I think the other key is that, while this is a massive amount of money to have on the books, and if you took it alone and put it into a publicly traded company, I think they'd be a top 25 market cap company in the S&P 500, which is interesting. But Berkshire is so large right now that to make an impact on their portfolio, they're going to have to make some larger moves. So my sense is, they're keeping their powder dry, waiting for the right opportunity, and they're going to make a move to, impact the top level of their portfolio.
Right. And later on this presentation, we have a slide on one of Berkshire's acquisitions of a company, that is a wholly owned subsidiary of Berkshire Hathaway, and that when he bought it 10 years ago, it was his largest ever acquisition. And when you see what was the largest acquisition 10 years ago versus what might be today, you can see how different the business has become. Okay, now the next question for Adam is, of course, one of the things that the Berkshire lovers, I shouldn't say it that way. It sounds like I'm criticizing people like Berkshire, and that's wrong. But people who are, Warren Buffett fans like about investing in Berkshire is that if the market sells off, Warren Buffett is very good at investing in a down market and buying stuff. And one of the things, though, that he has done, is that he gets these special deals, like he buys preference shares with high, when companies have gotten in trouble, he's bought preference shares with high coupons. He gets warrants with them. You can see the yields he got on those preference shares. And part of the reason that he's able to do it is companies might have been able to go to a PE fund or a hedge fund that would have done this deal maybe for a lesser yield. Maybe Adam will push back against that. But these companies wanted to have Warren Buffett on the shareholder register as sort of a seal of approval because it helps them raise capital in other ways. And the second half of my question for Adam is, when Buffett is really gone from Berkshire, will this end? Is this something is this sort of a Warren Buffett, something that Warren Buffett brings to Berkshire that it won't have when he goes away?
Yeah, I mean, having him on your cap table is certainly an interesting point. It gives investors confidence that, the company's invested in is, in safe hands. But look, I mean, these type of deals are embedded in the DNA of Berkshire Hathaway, right? So Greg Abel has been at Berkshire Hathaway for 20 plus years. In essence, he's been in operating control for the past 3 to 5 years, even on the investment side. So while the news of Warren stepping down from day-to-day operations was, viewed by some as a negative, the reality is that Greg is running the company. So, my sense is that Greg Abel has been steeped in the Warren Buffett philosophy, much like the rest of the organization. And there will not be drastic changes in investment strategy going forward. Because this is what has made them successful. I mean, certainly Warren Buffett is the best investor in the world, in the history of the world, probably. So yeah, I think Berkshire is the brand, even more so than Buffett to some extent over the last several years, because smart money knows who's been running the company.
Okay, so now we're going to let Adam introduce himself a little bit. Now, we have a lot of slides on the ETF that Adam is here to talk about the most, the OMAH. So I put this slide up so he can just give a quick introduction. And so we don't run over time, I'll have to caution you, Adam, do it really fast, but of the other ETFs that his firm manages.
Do you want me to go through my background quickly on this slide, or is there another slide?
No, that's the slide after this.
Okay, great. So yeah, so VistaShares is coming out with interesting strategies to fill white space and create products that have clear use cases. So we have 3 different families of products. Our option income, we'll talk about OMAH in detail. QUSA, ACKY. ACKY is a product that we just launched last week. It's invest like Bill Ackman, but with income. QUSA is quality portfolio with income, and of course OMAH is invest like Buffett with income. All these are generating 15% annually, paid monthly. Our growth equity AIS is our AI infrastructure ETF. So I was smiling when you were showing Dan Ives' product. We put GE Vernova in the portfolio 6 months ago. So we have a really interesting investment committee that picks stocks there. And then we have our tactical alpha product, which is more of a trading product. It's the 2x levered product, institutional high beta type exposure.
Okay, and I think since Adam touched on it here, so just in case you're wondering, the OMAH ETF, that's obviously for Omaha, where the headquarters of Omaha, Nebraska is, where Berkshire Hathaway is headquartered. And by option income, and for a lot of our reps who are on this call here, that they should listen carefully. This is where Adam's firm tries to give the ETF a higher yield by doing option strategies, which are also very similar to a lot of the strategies that are embedded in some of the structured products that our company offers to its clients. So if you're listening clear, when Adam gets a chance to talk about those option strategies towards the end of this presentation, please, I know that a lot of you guys are listening at home and you're making yourself your evening tea. Make sure that you're back looking at the screen for that part, okay? Now here, this is what Adam just said. He's part of a team. This is where I say we should be very excited to have Adam speaking here, because you can see he's the founder and head honcho here of VistaShares. Adam, just give us a quick background on VistaShares before we go on to the next slide.
Sure. VistaShares is, a company I founded with John McNeil. John is the former president of Tesla, chief operating officer of Lyft. He's on the board of General Motors currently. He's the vice chairman of their autonomous vehicle division. He's an absolute tech guru, business building guru. We founded it together about 1.5 years ago. And he's on the investment committee for all these products to provide oversight. Professor Robert Whitelaw is our chief investment strategist. He's the former dean of NYU Stern School of Business and head of their finance department, just an absolute brilliant man, one of the best in portfolio construction around the world. And on our options income products, Jay Petruccelli is on our investment committee. He is the chief trading officer of Title Financial. They run about $42 billion in ETFs, and around 20 billion of those are in options income. So we have an incredible amount of talent on our investment committee, and we're really proud. And this is really what differentiates us in the marketplace.
Okay. So now we have a slide here about the Omaha ETF. So for me, I'll explain the ETF. So basically, the ETF owns all the shares that Warren Buffett, I can't say 100% of the shares, but the major shareholdings of Berkshire Hathaway, weighted similarly to the way Berkshire Hathaway holds it in their portfolio. And you can see kind of the key pieces of information here on this slide of how often they rebalance and whatever they would. But the first question I have here for Adam is, if you're kind of following Berkshire's investments, why did you decide to have Berkshire itself in the ETF, and why is it a 10% holding?
So yeah, so what OMAH does is, we designed this product because people love Berkshire Hathaway, but Berkshire Hathaway doesn't pay a dividend. So we figured, how do we create a product that would, in essence, provide you similar exposure, but allow you to create that synthetic dividend, if you already hold Berk B or not. So OMAH it's always 21 holdings. Berk B is always our top holding. So we rebalance quarterly. Berk B is reset to our top holding at 10% every quarter, and then we own the top 20 publicly traded holdings of Berkshire Hathaway in more or less the correct proportions. We keep that in there because we are trying to provide an exposure to Berk B, but with this 15%. So we did our research, we talked to people, advisors, and they said, well, we like the underlying holdings, but let's get a little Berkshire Hathaway in there as well, because that's in essence what we're trying to get access to. Our options income strategy is designed to provide 15% annually. We pay it monthly. So we're targeting 1.25% per month. Not more than that, not less than that, 1.25. We're paying out our 6 month. Our declaration date is next Friday. So that's the last day to get in for this month's dividend. In 6 months, the ETF has exceeded 500 million in assets. It's been extraordinarily successful. So we're humbled by that and really thankful.
Okay, so here is the return. So as Adam said, this is a really new product. So so Adam's immediately got to look at this as an American and say, we started in March, not May. But no, that is March the 5th, 2025 is the start date. And you can see the OMA is this is a cumulative return including dividends, and we went through and did it assuming the highest withholding tax for foreigners holding the OMA for when they receive the dividends. But sometimes some of our clients are not in the highest withholding tax bracket, so your return would be slightly better if that. So basically, I just want to show you that the fund is up. And you have to remember that chart I showed you at the beginning. Berkshire shares itself are not doing all that well, but this fund is up. So don't be turned off by the fact that it's not roaring higher with the rest of the market. Relative to kind of like what it's trying to do, it's doing okay. And of course, you can't judge anything that has a track record from it's only a 6-month track record. So let's get going here, and you can see exactly what I just said in the previous slide. Here is the share price of OMA, the ETF, and here's the Berkshire B, as Adam puts it, the Berk B. If for any of you who don't know your Berkshire Hathaway, until about 20 years ago, it only had the one class of shares, and Warren Buffett never split it. So the class of shares was going into the hundreds of thousands of dollars, and there was one transaction where Berkshire had to issue shares. So when they issued the new shares, they began issuing these Berkshire B shares, which are a fraction of the original Berkshire A shares, and they're at a bargain price of $490 a share. But anyhow, the point we have here is that the ETF has outperformed Berkshire shares during this period of time, especially since Trump's how should I say, the Liberation Day speech. So immediately when our analyst here, Jeffrey, started looking at this, he's like, why is it? And of course, the first thing that comes to mind is that Adam's fund is only looking at the listed companies that Berkshire owns, and he's not looking at all the other companies that Berkshire owns, which aren't listed. And on top of that, of course, Adam's already brought up that they have this option strategy, which you would think might have some impact and make, if the option strategy is working, it would help Omaha outperform Berkshire. So let's first here's a slide here about the private companies. And I put up See's Candy because, part of the reason Warren Buffett is Warren Buffett, he's a bit of a salesman, And so when he talks about his private companies, he's not really going to talk too much about, guy insurance companies because, people don't love insurance companies. But even though it's a small investment for him, he'll talk about See's Candy because people do love candy companies, right? But anyhow, when we were doing our analysis here, we used the assumption that it's hard to judge, that about 50% of Berkshire is the public companies and about 50% of Berkshire is the private companies. Then the next step I'm sorry, I got ahead of myself. So going to the private companies, just to remind you what they are, the biggest block of his private companies is his insurance company, and the marquee insurance company that Berkshire has, of course, is Geico, and that's also very well known in the US because of their ad campaign with the Geico Gecko. And just to show you what a great investment Geico was, is that Buffett initially put about $20 million to get a large position in Geico when the company was in financial difficulty. They put in a manager, by the name of John Byrne. I knew John's sons. I can say most ironically, this is from obviously when I was a youth, that as the manager of like one of the most famous auto insurers in the world, his son, I wonder if I could be sued for this. I don't think so. His sons were not the best drivers in the world. Okay. Anyhow, going back to it, the total cost of acquiring Geico for Warren Buffett was $2.3 billion. If you look at its closest competitor, Progressive Insurance, which is a very similar company but a little bit larger, its market cap is 143 billion. So if you throw a valuation of Geico of around 80 billion or something like that, Warren's $2.3 billion investment to 80 billion sounds very good. So Warren Buffett is very good at investing in private companies. The other private businesses that you can see that we mention here is the Burlington Northern Santa Fe Railroad, Berkshire Hathaway Energy. Most people don't realize Warren Buffett is the largest investor in renewable energy in the United States, meaning he's put more money into solar, what do they call them? Solar fields, whatever, than anybody else. And of course, this is what I alluded to earlier. At one time, this was his largest ever private investment, Precision Castparts, which makes parts for the aerospace industry. So we'll keep going here. And now this is where, where Jeffrey Tan, the analyst here, and I got to be a little bit like scientists. What we did is that we took a look at Adam's ETF, and we looked at kind of like what it holds, and then we took the so we took that. Excuse me, I'm getting ahead of myself. What we took here was the private companies that Berkshire owns, and then we looked for publicly listed companies that are very similar. Sometimes it took two companies to be similar. Like if you get down to what I just mentioned, Precision Cast Parts, really that's represented by two different companies, Howmet Aerospace and Allegheny Technologies. Those are both listed companies that you can buy, and they compete or are in similar businesses as Precision Cast Part. And as if you look over and you look at Geico, obviously there we have Progressive, but you have several different utility companies representing Berkshire Hathaway Energy. Since I'm in the mode of personal discussion here, like I've mentioned before, I own a couple of homes in Nevada that I rent out. And sure enough, when I, at times when they're empty and I have to pay the utility bills, I'm paying the utility bills to NV Energy, NV for Nevada, which is owned by Berkshire Hathaway. So these are huge, big businesses that you don't really think about too much when you invest in Berkshire, but they're really very important to Berkshire. Um, Adam, do you want to chime in with any little thoughts on this here?
Well, it's an interesting analysis you did here. This is very interesting. But going back to your other question, it kind of underscores why we have Berkshire in our portfolio, because we want exposure to the privates and the cash hoard and, all the things that you don't necessarily get in the top 20 publicly traded holdings.
Right. And really some of these are not perfect analogies, but some of them are very close. I can tell you, Cisco Corp and McLean are close enough that I always get those two companies, having worked early in my career in the food business, I know a little bit about it. I get those companies are similar enough. I always get them confused. Whereas Energizer versus Duracell, Duracell is, obviously at one time Berkshire owned a large position in Duracell and they've sold down, but they retained some interest in it. Duracell is just a much, much better business company than Energizer. But some of them are very good. Sherwin-Williams versus Benjamin Moore. That's a pretty good analogy there. Okay, so basically back to the original question. So basically we have, basically what we did is we created what's labeled here as our basket, which is half Berkshire Hathaway and half these stocks here, right? Union Pacific, NextEra Energy, etc. And what we expected, because Berkshire's been underperforming, that adding all these companies that are very similar to Berkshire's private business would cause it to underperform, not do so well, because why else was Berkshire going down? It must be because the market was thinking that if Adam's fund was doing just fine, which is all the public businesses, and Berkshire shares are not doing so well, it must be the private businesses that are not doing so well. But here, when you have our version of Berkshire's private businesses in there, the shares are doing just fine. And in actual fact, our basket, and this will be interesting for Adam, so I'll let him think, that our basket, which remember is half OMAH, and it's half, it's half that list of companies that are meant to imitate Berkshire's private businesses, have actually outperformed OMAH, which is sort of the opposite of what we expected to see at the beginning.
Is this the OMAH? Is this only price return or is this total return?
Jeffrey says total return.
Interesting.
Yeah.
Interesting.
So,
well, okay, go on. I'm sorry.
Yeah. So Well, let's see. Sometimes, like, before you guys get all excited, remember you have to be cautioned. We're looking at a fairly short time frame. So, but still, it's interesting. So basically, to go back to the original slide we showed, where Adam's fund is outperforming Berkshire. I'm pretty sure this one's a price return, but anyhow, it is outperforming. Uh, if if you go back to this one, the explanation does not seem to be due to Berkshire's private businesses. So although Adam may not like me saying this here on this call, but if you were looking at this moment in time, if someone said, which would you rather buy, looking at this chart only, OMH, OMAH, or Berkshire, and then we can get in later about Adam's option strategy, whether that makes you change your mind. You would tend to say, well, I'll buy for Berkshire because it sounds like the market isn't appreciating that Berkshire's private businesses are probably doing pretty darn well. And it looks like my camera just went dead. Jeffrey, is my voice still up there? I reappeared. Good. Okay. So now we're just, I decided to do one example of a private investment for Berkshire. The first thing that I wanted to point out on this is that you can see the amount of this investment, which was $32 billion in 2016. I was pretty correct when I said 10 years ago. I guess it was 9 years ago when Berkshire bought Precision Castparts. And that was his largest ever investment at the time. You can be pretty sure with if Berkshire's looking to do another large deal today, that will be something that could be transformative to Berkshire. It'll be a much larger transaction than 32 billion. And then the other thing, as you can see the headline here, right? You can see that this was what Warren Buffett called a mistake himself, that he paid too much for it. And the reason and so I'm going to have Adam, so you just don't hear my voice all the time, explain what it means when Berkshire in August 2020 decided to write down $10 billion of Precision's value on Berkshire's book.
Yeah, I mean, they certainly, and I don't know all the intricacies behind this one particular transaction, but when they're writing it down, they clearly the financial results of this company did not meet expectations. So just like a public stock would be, hammered in the marketplace. His estimate based on the forward-looking earnings is that the company was simply worth less. So you take the write down now and hope that in the future results will improve, and you still make a good amount of money, but it takes your basis down for tax purposes.
Okay, and the reason that the reason why this is so interesting is think about how hard it might be to be an analyst for Berkshire Hathaway, because you have Warren Buffett saying that Precision Castpart was a mistake and he paid too much for it and he's writing it down. So that makes you kind of, is his biggest private investment ever. That's a negative for Berkshire stock. But at that point where Berkshire wrote it down, as it was, Warren Buffett is not completely clairvoyant. That was the bottom of the cycle for this particular industry. And we'll go to the next slide and look at what, from the time when Warren Buffett wrote it down, look at the two competitors of Precision Castpart. If you had gone in and bought Allegheny Technology, it's up 1,300% since that date. If you had gone in and bought Howmet Aerospace, I mean, how much I have to look at, you see the new thing is up 1,300%. So basically, just, just if you're trying to figure out what message I'm trying to tell you here, I'm basically saying that, the private part of Berkshire's businesses, right? They go up and down with value. And, it's a challenge for analysts who are looking at Berkshire because it's so diverse to really understand, what is the, what is the opportunity for each one of those businesses. But suffice it to say, if you're trying to say, oh, Berkshire's gone up a lot over the last 5 years and stuff, you got to remember one of their key businesses has just during the last 5 years since 2020, Precision Castparts, something you never hear people talk about when they're talking about Berkshire, has probably gone up its value has gone up multiple times since Berkshire wrote it down by 10 billion from 32 billion down to probably 20 billion in value. Okay, now we're going to get a little bit of a weird segue here. I have a slide called structured products. And I already kind of mentioned this at the beginning of the presentation. And it basically, this is a slide in the US, how structured product sales are going. And of course, structured product sales have always been very, very popular in Asia. So why are we talking about it? Well, because Adam, and this is why Adam's ETF does some of the strategies that do get embedded in some of the popular structured products here in Asia. So he's doing some of the option trades that when you buy a structured product, you're getting exposure to, and you can get exposure to the same sort of tactics, option strategies, just by buying Adam's ETF. So Adam, I control the slides, but I'm going to let you sort of do the talking and tell me, to move through the slides as you talk. I'm going to give you a warning that in the interest of space, we edited out a few of your slides. So don't be too surprised if a couple of them disappeared. But anyhow.
Can I mention one thing though?
Yeah,
about the performance of Berkshire Hathaway, which is often missed. When we came out of Liberation Day, I call it the tariff tantrums. The market, we were moving into a value-oriented market over the first quarter, which is, Berkshire Hathaway is a value-oriented stock, right? But what happened coming out of the tariff tantrums is that the market snapped right back into a momentum-driven market, meaning the mega cap tech companies were the leaders. As we know, the S&P 500 is about 35% over-concentrated in its top 10 holdings, which are all mega cap tech, right? So my thesis is just that we have moved into a momentum-driven market. Berkshire Hathaway is not a momentum stock. It's clearly a value stock and has lagged along with quality portfolios and other value portfolios. So, it's a kind of like a coiled spring, right? So, market leadership will change. Once we've been in a momentum market for so long, as it changes back into a value and quality market, I think we're going to see Berkshire Hathaway's performance take off. The other thing is that Berkshire Hathaway's top holding and Omaha's second largest holding is Apple. So the only mega cap tech stock that lagged over the last 6 months was Apple, in fact. So, there was some drag on Berkshire Hathaway, which I think is more of a blip as we, we'll look back in a year or two. So we can go forward and I can explain the option strategy.
Okay, I should just lead in by saying that I put in and then Adam will understand it, the Reese's peanut butter analogy, where you have two great tastes, peanut butter and chocolate in one candy. So Adam, go ahead.
So the way we designed this product is we went out into the marketplace and trying to figure out, income products are become very important to investors. The reason for this is that, we're in volatile times with a lot of global macro risks. People want exposure to equities, but there's a little fear on the downside, right? So having an income strategy that pays you a robust income stream consistently over time, kind of dampens that the fear factor of the equity market. So we went out and we said to investors, what are you missing? What do you like? And of course, we kept getting feedback that people love Berkshire Hathaway. It's one of my top holdings. I love Berkshire Hathaway. It's a holding, but it doesn't pay a dividend, which we all know. So we said, well, what if we can create a Berkshire Hathaway portfolio, but pay a dividend? So people who own Berkshire B can carve off a little piece of their exposure and add OMAH and create more of let's say synthetic dividend with similar equity exposure, but with the income stream. And that was why we developed OMAH. It's invest like Warren Buffett, but with 15% annual income paid monthly. Right. So we have a Target 15 family of products, right? So OMAH is our first one. Then we launched QUSA. All of them pay out or seek to pay out the 15% annually with a monthly 1.25%. QUSA was our second one, which is a quality portfolio, which has similarly been out of favor for the last, several months, but will become a leader, hopefully, in the next cycle. And then we just launched ACKY last Tuesday, which is invest like Bill Ackman, but with 15% income. So it's a similar strategy to Omaha, except that we use Bill Ackman's core portfolio instead of Warren Buffett's. So our goals with these products is, number one, is to hit our target 15 on an annual basis, paid 1.25% per month. And our second goal is to have capital appreciation over time. And the option strategy it's really very simple. It's data driven. So our goal is we cover the entire portfolio. So we are selling call options, out of the money calls on each one of the underlying holdings. And with the goal of scraping off that 1.25% per month on each equity. So, we are not waking up in the morning and saying, let's maximize income. We don't want to maximize income. We want to hit the 125. If we hit 126, we're rolling the rest of that income back into the net asset value of the fund. Similarly, if dividends are paid on the underlying holdings, that is not included in the 15%. Those dividends are reinvested in the net asset value because we want to avoid one of the issues with some of the much higher income type ETFs where there's NAV erosion. That you won't experience with a product like ours because of the way we've designed it and the way we run it. So it's a very simple data-driven option strategy, but the team that runs it has been doing it for many years, and they're running about 18 billion in similar strategies. So we're paying our next declaration date is this coming Friday, not tomorrow, a week from tomorrow, and so that's when we declare that we're going to be paying out the 125, and payday is on Tuesday, the following Tuesday, the 30th.
Okay, so I'll just ask a quick question here. Like if we go back to April when the market had its tariff tantrum, as you put it, and you have, 20 stocks in your ETF, just to remind people, he's selling these call options. So he's short the call options. Of course, he's long the underlying. So if you're short, you want it to go to zero. We're not used to wanting things to go to zero, but of course you want those calls to go zero. During that period of time, what percentage of the calls that you had shorted did go to zero?
I don't have that piece of information, so I don't know the answer. What I can tell you is that we're not going to hold the call. We're not going to hold those options positions until they expire. In most cases, what we're doing there is we're trying to get out of the options position once we hit that 125. The minute we hit the 125, we're out of the position and we re-roll into a new position. The other important point to your point is that when the market goes straight down, another strategy we use is using call spreads, because call spreads allow you to retain more of the upside of the position as well. So we'll mix in call spreads when the market is goes straight down and we're expecting it to snap back up. But one important point, and I want to make this very clear to all your listeners, is that any option strategy, whether it's a VistaShare strategy or whomever it is, you will never keep up in a bull market versus the same portfolio of equities only without options. That's because there's no free lunch, right? So if we're generating 15% income per year, that's coming from somewhere. And to Paul's point, there's, degradation of the upside capture. So I tell everybody with a product like OMAH, you should expect 75% of the upside and around 85% of the downside versus a portfolio of just the equities. So that's very important to note. And that's why when you were doing those comparisons, I kept asking, is this total return? Because the price return, it tells only part of the story with one of these types of products.
Okay, so I'm going to give a little warning to the audience. We have a lot more slides, but some of those slides are stuff that I made. They're not that important, so we're going to skip them and just end after we finish the option discussion here. So we will be ending fairly soon. As I move to the next slide, I'll just, I'll ask Adam, is that when you're doing your option, well, let's just go to the next slide because I'm seeing you guys putting in questions. Oh, I know what the question I wanted to ask was. If you were going to make an argument for this portfolio, you could say that although you wouldn't describe the OMA underlying portfolio as defensive, you would say it's probably lower beta than the market as a whole. So it's a little less volatile if the market sells down. Doesn't mean it's defensive, but less volatile. And on top of that, because you're selling calls, that gives you a little bit more protection because the calls are going to drop in value, which is good because you're short them. So are people who are buying it today, you said that your fund got off to a very good start. Do you think they're buying this because they're saying, well, the market is so high, maybe there isn't so much upside, and here's something that's going to outperform if things go down? So I can buy this. If the market continues to go up, I'll make money. If the market goes down, I'll be a little better off. Is that the sort of logic of your buyers today, Adam?
Yeah, I mean, you nailed it on the head. So if you look at the S&P 500, 35% is in the top 10 names, mega cap tech. The mega cap tech stocks have just had a historic run for years. So, what investors are doing is starting to say, well, this maybe a little overextended. Let's carve off some of my S&P and my QQQ exposure. QQQ, 45% is in the top 10, and it's almost the same exact names as the S&P. So people who are invested in the Qs and the S&P think they're diversified, but they are over concentrated in the same names. So to your point, Berkshire Hathaway is a value-oriented portfolio, certainly lower beta, lower volatility. I would say now is the ideal time to carve off some of your exposure in those mega cap names through those other indexes and diversify your core equity exposure into some of the names, that are in OMAH, where you probably don't have the same levels of exposure and should do well, particularly now that we're in a rate environment that's being reduced, a little more interest rate sensitive names. So I think it's a good time, and we'll see the performance of Berkshire Hathaway improve, over the next 6 to 12 months, I believe, as market leadership changes away from the mega cap techs.
Okay. So we're going to get into these are actually they're Jeffrey's questions, and then after that we'll get into the questions from the audience.
Great.
So, and then we'll wrap things up. So first thing is, how often do you change the holdings of the underlying?
So we rebalance the overall portfolio quarterly. So 4 times a year, we are looking at the Berkshire Hathaway holdings, and we're readjusting our portfolio based on any changes that they make. At that time, we're resetting Berkshire Hathaway exposure back to 10%. So if it's floated up or down, it's reset to 10%. However, we are an active ETF. So we're active to a rules-based core. The rules-based core is what I just described as the quarterly rebalance. But if we, as an active ETF with an investment committee, if we see a change intra-quarter, we can make that change, when we first learn about it, whether it's through SEC filings or things like that, or public announcements.
Right. So basically, if just to let you know what to translate what Adam said, if Berkshire takes a large position in a large company and then he has to file a SEC filing to say that he's taken that position, Adam will be, everybody in the world will find out about it, and Adam's team will make a decision on whether this is so important that he should rejig the holdings in the basket. So, so basically, we're going to go into the. I actually, some of these slides relate to Adam, so I'm going to do them very quickly. So here we have here that Warren Buffett, one of the things that he looks for in a company are moats. Companies that, because he doesn't like saying have pricing power, because that sounds monopolistic. So he just used the word moat. That sounds more interesting. And just to remind you, previously we've talked about the VanEck, which has a ETF MOAT that follows companies that have moats. And the reason they do that with Morningstar is when Morningstar rates companies as part of their rating system, when they give a 1-star, 2-star, 3-star, they talk about moats. And so now, like I promised Adam, that gets back to here, you can see in Adam's ETF, as you can see, a lot of them have fairly favorable ratings from Morningstar in terms of, whether they're good stocks or not. Berkshire itself is 3 stars. The only 4-star they have is Occidental Petroleum. And what's also interesting is, as you would expect, many of the stocks that are held in Adam's ETF have wide moats, but not all of them. Interestingly, if you go to, my basket here of the fake Warren Buffett basket of private companies, you'll see actually his private companies, he has very few companies that have wide moats. But interestingly enough, if, like I pointed out, that one of the companies that really made Berkshire is Geico Insurance, and the car insurance company business doesn't have a wide moat at all. So that's very interesting. And anyhow, here you go. We rewrite, if you want to get the PowerPoint, you can see the Morningstar ratings, and you can see that Morningstar rates a lot of those private companies that are supposed to be mirrors to Warren Buffett's companies. These actually really have a lot of 3 stars and 4 stars. So these companies, it's telling you that even though we were saying that these shares have done well, Morningstar is still showing those as something they find to be attractive. And that will be the last. So I'm going to go to the slide that says questions, and we will get into the questions. The first thing someone wanted to, let me see if I can, I'm just going to take them in order so I don't get confused. Okay, Adam, do you have, someone wants your opinion on the Buffett indicator of whether the stock market's overvalued or not.
You know what? I saw that about 2 months ago. And I believe at that point, the Buffett indicator did in fact indicate that the market was overvalued. I could be wrong on that, so I would have to get back to you, but I remember reading about it a couple months ago. And that's what it said. But, the article that talked about it also talked about it's one indicator, right? So it doesn't take into account all the different dynamics in the market at that time. So but I don't think anyone could dispute that. We're seeing extraordinary forward PE ratios on a lot of these mega cap companies. So mega cap tech has been driving the market, and the valuations, in my opinion, are extended. And I think investors need to get diversified.
Okay, someone asked a specific on when you pay your distributions, right? So how much of it is from capital and how much of is it from what you would call income?
Great. So we try to maximize what's called ROC, return on capital. It's not actually return on capital, it's a tax treatment, which means that that portion of the income is not taxed at that time until you sell the ETF, which could down the road. So that's what investors want, is a higher ROC. So we're seeking to maximize that. We've been all over the place. 1 month we were at 90, then a couple months ago we were at 35%. So it depends on the dynamics in the market, the volatility of the underlying options. But that is part of the calculus of how we're driving the options income strategy. So my guess is, I tell investors that we should be expecting somewhere in the 70 to 80% range on average over a full year. But there will be variation on a month-to-month basis.
Okay. So here's just a question. What happens if all your calls become in the money?
Well, again, we are holding the calls to the point where we're hitting that 125. So we are not holding positions for the full duration of that position, right? The minute we hit 125, we're out of the position. So we don't want people to call away our stocks, right? So that is something we are actively avoiding. So that's really the key here. And that really differentiates us from some of the other options income products out there where they're trying to maximize income. They're on the edge, right? They're trying to maximize, get that last penny in. We don't want to do that. We hit the 125, we roll out, and we roll right back into a new position.
Right. So just remember, a lot of people who don't trade options, it's a little counterintuitive, but remember, since they're long the stock, market going up makes them money, even if the value of the calls go up in price, right? You're always got to make more money. So what you're really losing there is that if you had just owned the stock and not been short the call, you would have made a lot more money. So you're missing out on profit, but you're not creating a loss.
Correct.
Okay.
And that's why it's important that we won't keep up in a bull market, right? To your point, right? That's the key.
Okay. Okay. So once again, so I'm going to read the question because I know I'm going to read the question exactly as written because I think this is the best way to do it. What will be the strategy to maintain the 15% annual return in the event of a sell down? So he's talking about the market dropping.
Well, I don't think that really impacts the strategy at all because we're using the options. We're looking at the options on a per company basis. So the overall volatility, whether it's up or down volatility, volatility is our friend when it comes to the options. What's not our friend is if volatility goes to zero, right? That's what you don't want because then it's hard to put those positions on. What we've done when we built this portfolio is, of course, we look back many, many years at the portfolio of stocks to determine if, in fact, there was ever a case where we couldn't execute the strategy. Now, in the scheme of things, if for some reason volatility went to zero, we couldn't do anything, then there's other strategies you can employ. We have the ability to use index options as well on the S&P or other indexes. We won't. That's something we don't want to do, but we could do it if we had to.
Okay, just to remind people, so basically that if the market goes down, your option strategy is probably doing very well. But the problem is you own all the stocks and they're dropping in price. And as you could see when we put the slide up of what happened in that big sell-off, Adam's ETF dropped right along with the market during the sell-off. Now, if you really got into it, he would probably point out, well, it really didn't drop as much as the general market. It wasn't so bad, right? But still, his stock is a long portfolio. So when markets go up, it goes up in value. When markets go down, it goes down in value. Okay, the next question is about, can you help to understand what is the future plan for Berkshire Berkshire Hathaway's leadership after Warren Buffett leaves?
Yeah, so Greg Abel is the CEO. Greg Abel has been at Berkshire Hathaway for about 20 years. He's been one of his lieutenants for this whole period of time. Um, the street believes that Greg Abel has been running the day-to-day operations on the investment side for the last 3 to 5 years, as it is. So Greg Abel is very able. he's been steeped in in Warren Buffett's doctrine. In his investment strategy. He's been running the investment strategy. So we don't view that there'll be any hiccup in any type of operations or any type of strategy because, of Greg Abel's background. He's a star. And look, Warren Buffett's still involved. He's still the chairman. God forbid something happens to him. Greg Abel's, a firm set of hands that has Warren Buffett's philosophy embedded in his DNA.
Okay. So here's just a simple question. What is the management fee for the ETF?
Management fee is 95 basis points. It's very expensive to run an options income strategy. And but we're in line with other options income products out there, most of which pay out a lot less than 15%. So, you can look at some of the other products out there. They're in the 70 range, but they're paying 10 to 12%. So, we're at 95, but we're paying an extra 3 or 4% than the competitive set.
Okay. So now we're gonna, we have to queue up our assistant here to say goodbye to everyone because we're on the last question. And the last question is sort of like it's an ETF, so you can't reinvest the dividends, but basically all the income that you have as an ETF, you're required to distribute it. Correct, Adam?
Well, again, we are distributing 1.25% per month. That is the goal. Anything above, if we generate more than that, that is being rolled back into the net asset value of the fund, as well as dividends. So if dividends are paid by the underlying holdings, that's rolled back into the net asset value of the fund. We are paying 1.25%, not more, not less. That's the goal. There might be deviations on a month-to-month basis because you can't guarantee anything. But, since this product's been out, it's 1.25% per month, and that is our goal.
Okay. Well, one of the things I wanted to say on the dividends, like I think I was trying to pull back because I think I did make a slide on it that one of Warren Buffett's investments are in utility stocks, right? Mm-hmm. And on the subject of utility stocks, in a previous guest that we had for our long-term listeners, Tony Petrelli, was kind of mentioning that he was buying U.S. utility stocks for the first time in his career as growth stocks. And at the time, I sort of poo-pooed it, right? Because I said, foreign investors shouldn't be buying U.S. utilities because they pay out such high dividends, and that's very tax inefficient. Actually, my advice was, bad advice, because although it is true that you might wind up being subject to withholding tax on the dividends from those utilities, they did go up a lot. They would have been pretty good investments. So basically, if you like, Adam's strategy, right, you should, you have to recognize that some of it's got to be, when we did our slide there, we assumed the worst case scenario for withholding tax, right? So that's got to be the worst it's going to be. But that you're going to pay that, but if the strategy works, it's still got to be a good stock. We just had two quick questions. One, I never read out the name of the person, but the person uses a very funny pseudonym, so I'm gonna say it out. Greedy B asked, I notice OMA spread is quite big. How is the liquidity?
Well, I don't know what they're looking at right now. It's before market hours here in the United States. So I don't know how it trades after hours, but within U.S. market hours, it typically trades 1 penny wide. Our average daily volume is around 600,000 or 700,000 shares per day, and the assets in the fund are about 525 million right now. So extremely liquid and extremely tight trading.
Okay. Well, okay. The next question, I'll try to do it really quick, and then we'll hang. The person was asking, well, if the fund, if the fund does not make 15% in a year, how will we be able to pay out 1.25% per month? Now you got to remember, you can't look at the history here because it's only since March. But anyhow, Adam can kind of enlighten us a little bit there.
Well, our first goal is the 15% annually. And to get to that 15%, we have to get to the 125 per month. There might be months where we miss 125. We'll have to make it up in a subsequent month. But the name Target 15 is in the name of the fund. We better make the 15%. Or we're going to disappoint investors. And look, again, no guarantees. I can't guarantee anything, but that is the primary goal of the fund. The secondary goal is capital appreciation.
Okay. So why don't we jump on now and say goodbye, and I'll just leave to Adam. I got a message here from Greedy B that says thank you.
Thank you, Greedy B. And everyone hopefully can, follow me on X. I'm under Adam Patty on X. I'm always putting out information. More importantly, take a look at our website, vistashares.com. We have a lot of information up there, a lot of educational materials, white papers, all kinds of things. And look, always reach out to me if you have any questions. I'm happy to answer questions all day long.
Well, thank you, Paul and Adam, for this insightful presentation. For more upcoming webinars, please visit utrade.com.sg. Once again, thank you for joining us today and enjoy the rest of your evening.